Good morning, everyone. I'm Bagger Don at StockMarketCaddy.com. Today is October 1st, Saturday, at about 10:30 a.m. You are looking at our proprietary tool called the SMC Driving Range Radar or Sentiment Gauge. SMC is for Stock Market Caddy. We happen to be using the ETF structure because they are the most popular with retail traders and maybe with our members as well. We can use this very same tool though with stocks, with futures. What this shows us is just what it is titled, the sentiment gauge. So let's take a look at the VXX, which is a moniker is fear gauge. It's an ETF that is meant to track the VIX structure on a daily basis. And you can see that the VIX is in euphoria. Anybody who went long volatility is feeling really good, but it is a contrarian's indicator when it comes to the market, because many times when the VIX is in euphoria, the markets are where? Very close to panic. The DIA is the diamonds, the Dow. IWM is the Russell 2000. QQQs are the NASDAQ, and the SPY is the S&P 500. Now the markets are very close, or have been in panic and are oscillating back and forth. It isn't a good idea to be taking or paying for insurance or selling when markets are in panic. You want to do so much earlier. But just because they get into panic, it doesn't mean that they're obligated to run all the way back into euphoria. That may not happen. The markets keep adjusting themselves, adjusting to lower ranges. But it is likely over the next few weeks that they will move back toward the mean, but not obligated to euphoria. And the VIX structure is likely to come in at that time. You can also see the individual sectors. This is the gold miners, the biotechs, the transports, the regional banks, not doing well. Building materials, energy, financials, not doing well. Industrials, not doing well. Technology, staples, not even doing well. Utilities, nothing is working. The only thing that is working happens to be the dollar. A dollar futures contract purchased back in February for just $2,000 is worth over $20,000 today. A tenfold return on cash, leverage cash. Bonds also not doing real well. Bonds do what in higher rate environment? They go down. Now, I wouldn't short bonds now. The rates are likely to come in a little bit and might rally for the aggressive trader. If you find yourself thinking, well, the market has to come back, the market will come back, it can't go down forever, be careful. It's not likely to go down forever, but it can go down much, much lower. It is not obligated to come back to the old highs. I am reminded that in 1999 to early 2000, the NASDAQ hit its high at that time of a little over 5,000. Had many more stocks, much more promise than today's market. And in 9 short months, the NASDAQ fell 90%. It did not come back to 5,000 until some 10 years later. And many of the stocks that went for that ride up to 5,000 were actually out of business. I'm Bagger Don at Stock Market Caddy. Feel free to give us a shout. This view is available to our monthly members every night. Our annual members have this tool as well as other tools on their desktop. So they can do what? play their own game. My phone number is 813-758-8263. Good luck, everybody.